You are watching BQ Prime and NDTV segment Let's Talk Business, where you can catch the latest news and updates on business and finance from across the world. Well, a dull trading session as both Sensex and Nifty ended little changed compared to Friday's close. The Nifty 50 looked to trade above the 19,700 mark, but closed below it. The outperformance came from mid-caps, real estate stocks and banking names. The Nifty Bank also closed above the 44,760 mark. Now, besides real estate, another theme that was in focus was sugar, with stocks ending with gains between 5 to 10%. And moving on to action from Dalal Street, the National Stock Exchange is finalizing plans to extend trading hours for equity derivatives soon. Now, as per reports, the exchange is proposing an evening session, possibly between 6 p.m. and 9 p.m., when market participants can continue trading futures and options contracts after the regular session between 9:15 a.m. and 3:30 p.m. is over. BQ Prime's Tamanna Inamdar and Neeraj Shah here to explain us how this will work. Over to you, Tamanna.
It's possible you will be seeing some after-hours action on the NSE futures and options. We have confirmed now that NSE is indeed planning to begin trading in their derivative segment from 6 to 9 p.m. There's a proposal that's gone. It's awaiting SEBI's approval. Neeraj, good idea, bad idea? What has been the response so far?
Well, from people who support it, I've heard wow. From people who don't support it, I've heard, okay, oh my God, what's happening? But factually, okay. So the argument that because Indian markets are now so globally linked, and if the globe is undergoing some transition, particularly the West, which is operating in that time band, should Indian traders and normal traders, local traders, have the option of trading the Nifty instead of 9:15 the next morning or 9 to 9:08 the next morning, that previous evening? Does that argument have merit? Probably it does. Is the infrastructure completely ready for something like this? Well, it can be managed per se by brokers as well, but perennially the problem, Tamanna, has been that, or the argument has been that, how will, Indian markets start early in the morning, stay up till 3:30, so and run till 3:30, and now if there's extension, and if it's not just an index extension, which I believe it will be, then how will the infrastructure cope up, both employee infrastructure as well as otherwise, and the costs for something like this? But that small aspect notwithstanding, is there merit to the argument that people should get a chance to probably trade? Yes, but are we prepared for such an extended trading day? Difficult to say.
And to my mind, it also reflects the kind of interest in this segment of the market in F&O. Those volumes have been massive, the participation has been much wider, and the interest has been there. My only question is that are there enough parallels globally for, to justify the kind of volumes that are expected? Are there no options right now, Gift City, etc., that we needed this? And will this then eventually logically extend to actually the underlying assets as well, that you trade on the NSE as well in after hours?
Now, for the longest time, we haven't quite seen the move happen beyond the index. So to think that the move like this starting off and very quickly moving into underlying trades happening, and therefore the stock trading also happening, I would presume it's a bit far-fetched. We probably a few, I don't want to define a time period, but some time away from that.
Yeah.
So it's just probably the index. And is that a good enough option to start with and test waters? Yes. The most widely traded instrument, if you will, Nifty futures, Nifty options. Start with that, see how it goes, test it for a period of time, see the participation, see the volumes, which I believe would be good, and then figure out. It's the same argument, right? That years ago, when the market started at 9:55 a.m. and eventually came to 9, and we was like, yeah, how will the volumes come about? But we've seen that, and there's no dearth of volumes per se, especially in the futures and options side in India now.
Yeah.
So I believe volumes will not be a problem. I know there are comments which are saying that volumes will not get built up, etc., and costs will only go up. I don't really think volumes will be an issue. The markets are open, trading will happen.
When I was looking through all of the social media kind of responses,
what did you see?
Very interesting theme that I saw is people saying that now those who are hooked to F&O trading have more hours. So either more hours to make or lose money, depending on, which way
somebody will lose. That's the nature of the instrument. Yeah.
So there definitely will be a lot of interest out there, and the kind of participation we've seen, especially post-pandemic, will justify the volumes. The question is, what does it do to the infrastructure? Like you said, costs will go up. You'll meet second shifts at brokerages.
Maybe, yeah.
Yeah, more infrastructure and all of that. But I think in a world which is so linked, and we're in a city that never sleeps, it will all work out at the end of it.
Yeah, I mean, there's also a utopian world argument, what happens to mental balances and work hours, etc. That's a completely separate argument and it can go on forever. But purely from accessibility and an instrument being available, which is available to a select few now being available to everybody else, is also an argument that I've heard from a proponent of this, and not the exchange, by the way, somebody else who's a proponent, and many people who are proponents, they say that they are actually very happy with this happening.
So tell us what you think. Tell us what you think. Tell us if you think this is a good idea, this is a bad idea. How excited are you about it? Are you ready to partake? And also just to underline that this is right now at proposal stage. It's not like it's going to happen tomorrow or day after.
Yeah.
But we do have confirmation from NSE that it is in the works. We'll have to wait and see how it goes.
Equity markets are likely to remain under pressure as central banks around the globe continue to withdraw liquidity. This is what JPMorgan's Sanjay Mookim has said while speaking on the sidelines of the India Investor Summit. He also talks about banking outperforming the other large caps. Listen in.
We were tactically bullish in March and we turned cautious in July.
Right.
And the reason for that, Neeraj, was not valuations, it was actually liquidity. Okay. And we've seen for the last 15 years that global equity markets react to injections and withdrawals of liquidity by the major central banks. Yeah. In March, the Fed injected liquidity for the bailout of the small banks. We saw the market start to rally, growth started to rally, mid-caps in India started to do well. Starting July, June, you started to see the liquidity withdrawal happen as well. And this is for a shorter term trade, our research has been very clear. Valuations are your second filter. The first filter is earnings momentum, which is then amplified and multiples by the liquidity phenomena. So will I be positive now? The answer is no, because we continue to see liquidity withdrawal by central banks happening for the next several months,
right,
which should put a lid on equity upside here on.
Sanjay, based on your assessment of what market returns are likely to be because of the overarching factor of liquidity, where is it that you still find comfort to be able to tell your investors at the conference that these are the pockets that you as a team strongly believe still have a chance of outperformance in an otherwise sideways to a faltering market?
Okay. So there are 2 or 3 answers to that question. Okay. If you have a longer horizon, so let's say you're invested in India and you have the patience to be in here for the next 3 to 5 years, then you still may find enough companies which are executing well, which have growth visibility remaining very strong, and therefore you may then be willing to say that, okay, maybe the multiple is a bit too high, but I'm here for compounding and this is good for me. But the problem is, Neeraj, that most of my investors think of the structural story and the demographics, but expect returns in 12 months, right? And that's the challenge. So if you're looking for shorter term return, then you have to necessarily worry about the market direction, which we think is negative.
Meanwhile, India's inclusion in the widely tracked emerging market index was inevitable. This is what Sadir Chenoy, the chief India economist at JPMorgan, has said on the sidelines of the India Investor Summit. He also added that
this inclusion happening at the current point of time, because a lot of people would have thought that the reverse will hold true when an event happens, and if there is a flight out, even that might be a problem. But is Indian as an economy being so large and having the depth, is it a good time for India to be included?
It was inevitable. I think it's a good time because if you want idiosyncratic one-off flows, you want those flows to be counter-cyclical. You don't want them to be when your flows are already very strong, because that makes the RBI's problem worse. You want them at a time, for example, when FDI flows have slowed and the current account is wider because oil prices have gone up. So this is a good time. Couple of things, nuances here. One is that I think the benefit of this, as we've alluded to, is the passivity. That these are passive flows. And if people get excited about India, you take your weightage in India from 10% to 12%, you go overweight, as an example. If you're a little concerned, 10 becomes 8. So you don't see very large swings. And this brings much needed heterogeneity to the bond market. And I think that's good in the medium term for price discovery and for the health of the market. But we should be realistic precisely for the reasons we mentioned on what this means for market prices. Because when these flows come in, for all the reasons we've discussed, the RBI will probably buy those dollars up to prevent an appreciation of the currency. When you buy those dollars up, you will release rupee liquidity. And the RBI correctly wants to ensure that liquidity does not go out of hand, right? And is consistent with your monetary policy stance. So then you will sterilize that liquidity. And one potential way of sterilizing it is to sell government bonds and soak it up. So in a way, what this will do is this is very supportive for the BOP. But from a bond market perspective, think of this as being potentially a change in the central bank's balance sheet away from net domestic assets to net foreign assets. That you're buying more dollars, but because you have to sterilize that, you are selling bonds and reducing that exposure.
Well, that's all we could pack in this edition of Let's Talk Business. Slipping into a short break for now and back with more news on the other side.